All right, we're going to go ahead and kick things off here. Hey, everybody, good afternoon. I'm Jake Alexander from Action Accounting, joined by my good friend Adam Taylor. Adam, how you doing today?
Doing great, thank you.
Amazing. I would ask you how the weather is where you're from, but you're literally in the room right next to me. We're both here in sunny Florida, where it's 75 degrees and it feels great. So, thank you so much, everyone, for joining us. Everyone tuning in here live, and then everyone watching this recorded afterwards. Thank you so much for taking a little bit of time out of your day. Really means a lot to us. Adam and I find this kind of stuff near and dear to our hearts, and we love talking about it. So, it makes us feel great that you take a little bit of time out of your day to come spend it with us and learn about this stuff too. So, today we're going to talk about connecting tax strategy and long term wealth, which is a really amazing topic when you think about it. There's a lot of power in having a group of professionals working on your behalf to help you hit your long-term goals. And so we want to start and break that down. In respect of everyone's time, you always like to start with an agenda in true accountant fashion. We try to be as organized as possible. And we try to set as good as expectations as possible of what you can expect over the next 60 minutes here. And so we'll always get started with an introduction. At the end of the day, this presentation is not about us. It's about the content and the education that we want to provide to you. But I always think it's nice that we're not two perfect strangers up here talking to you for the next hour. So we always do quick introductions, talk about a little bit of housekeeping and just kind of what to expect. From there, we're going to go into our main section, which today we're going to talk about planning beyond April. Anyone in my world knows right now is an insanely busy time. Everyone's piling in at the last minute. Everyone wants to have conversations about, what do I do to save money on taxes? How much do I need to make as a payment? I'm here to tell you, like, April is just the beginning, and so we're going to talk about planning beyond April and things you can do between now and the rest of the year to really set yourself up for success. And we're going to talk about that from a tax strategy perspective and a long-term wealth perspective. If you're tuning in to this, you probably already know who I am, but I'll do a formal introduction here in a minute. I'm also going to introduce my special guest, Adam Taylor from Taylor Financial. And then we got plenty of time at the end of these for Q&A. So like the typical format for this event, just to do some quick housekeeping and lay out for everybody what to expect. We schedule these for 60 minutes, so usually 35 to 40 minutes of actual content of education. And then we do that on purpose. We always leave plenty of time at the end for Q&A. So we want to hear from you. We want to interact. We've got plenty of time at the end of the event for Q&A. But also, if something comes up during the event, pop it in the Q&A box. You can use that there down at the bottom. You've probably noticed this is not the typical like web meeting version of Zoom. This is the webinar version. So you can't turn on your camera and come off of mute and ask the questions. You got to type them in that Q&A box as a quick tech check. I always ask just a few people, or if everybody wants to do it, the more the merrier. Use that Q&A box in the bottom and just type in like your first name and where you're joining us from. That way we know it's working. The last thing I want is to be 55 minutes into this and understand that the technology itself wasn't working. So pop in that Q&A box, just type in your first name, type in where you're joining us from. Sometimes it comes up in the very bottom right next to the chat. Other times you might have to go to those little three dots on the right, click that, hit more Q&A, and it'll work there too. So just get that. Make sure we're working. Doug from Tampa. Okay, perfect. So we know it's working at least. We got Joe from Clearwater. Joe Olson. Hey, how you doing? Thanks for joining us. So very cool. All right, we got that working. With all that being said, we'll dive right in here. Ask your questions. We'll go ahead and kick this thing off. I'm Jake Alexander from Action Accounting. Like I said, if you're joining us, probably already know who I am, but I think it's good just to formally reintroduce myself, make sure we're not strangers. Action Accounting is the name of our business. We've been around for 10 years. There's a team of 11 of us. We got four main departments in our business. We have a bookkeeping department where all we do there is create financial statements for business owners, so they can understand how much income is coming into the business, how much expenses are going out. Most importantly, there we spend time consulting with the business owners to teach them how to read those financial statements. We found that in order to run a successful business, you've got to be very informed as to what's going on, and the more you understand those P&Ls, those balance sheets, just the better it's going to be for you long term. So we do bookkeeping. We also do tax preparation, which is right now we're in the height of that busy season. There we're preparing and filing all of the tax returns for last year's activity, which is a necessary part of the process. You got to file it for the business, or if you have a personal, everybody has a personal return, but if you have a separate business, we got to file those returns too. Then we've also got a separate department that does tax planning, and that's what we're going to talk about here today. That's what I want to applaud all of you for joining us here to tuning into to talk about, which is it's totally different from tax prep, where when we preparing and filing returns for last year, we're really doing like a retroactive process. Tax planning is the opposite, where we're being proactive. We're starting now in the beginning of the year to put strategies in place to have these conversations to help you understand what's going on out there and how many proactive strategies are available to save you as much money in taxes as possible. Then we also do business consulting. If you're looking to grow and scale your business, we can help you put systems and processes in place, mostly from the financial aspect and perspective, to help you turn that business into whatever it is you started it for in the first place. That's a little bit about me. Now I'm going to introduce Adam Taylor, and I can't help but notice you have a lot of letters behind your name, Adam, and I think you just got a couple more. I'm going to ask you about that here in just a sec. But how you doing today?
Yeah, doing great. Thank you. Thanks for having me.
Yep, absolutely. So Adam Taylor, he's the founder of Taylor Financial. They've got client based out of Tampa, but service clients all over the country. I know you graduated from FSU. We won't hold that against you. But you also come from a background in the hospitality industry, which I find very interesting. And I can tell from working with you on a daily basis, you can see where that has a major impact in just the level of attention and care that you provide to your clients. You can really tell where that makes a big impact, and that's an absolutely amazing thing. You've earned a ton of awards all over the place. You have a whole bunch of licenses and designations. And then last but certainly not least, most importantly, you're a husband and you have three wonderful kids and an amazing father too. So,
Well,
Adam, welcome.
thanks.
Thank you so much for being here. Tell us a little bit about this new designation or these new set of letters you got behind your name there.
Yeah, sure. Yeah, so anyway, just kind of quick little backup. So Taylor Financial, we've been in business since 2018. I've been in the industry since 2011. I used to be at Capital Grille as a managing partner, and kind of to echo what you said, Jake, it's important because what we have found in the financial services industry is that no one's really doing the service or not. They don't have that heart of a servant mentality. So really with us loving our clients, trying to anticipate needs and just create that, what we call a magic carpet ride for clients is really just, I believe, attributed to the hockey stick growth we've had over the last 8 years or so. But yeah, so the newest one is TPCP. So as you can see, I'm a dork and a bunch of letters, and the goal was to eventually have more letters behind my name than in my name. So I think I've checked that box. But
I would say I think
TPC,
you're there already. Yeah.
yeah, it's funny. My business card is like a widescreen business card, jokingly. But yeah, so TPCP is Tax Planning Certified Professional. So it's done through the American College, which is where pretty much all those other designations came from. And so there's three phases of this designation. It talks about the very beginning phase of tax planning during the accumulation phase. So before you retire, how do we make some tax mitigation strategies or just overall ideas? And then once we get into retirement, that's the second phase during retirement. How do we reduce taxes as much as possible? That could ultimately help with some other entitlement benefits. And then the third stage of this designation, this overall course, is tax planning at the end of life in special situations. There's been a lot of changes with like the Secure Act 2.0 and the One Big Beautiful Bill last year. And then what does tax look like? What about gifting? How much can you gift? When do you have to pay estate tax? In what state and what form and fashion? So it's really helped me tremendously because I believe, and you probably know this, a lot of our clients want to talk more about taxes, which I have now become a dork on as well.
Love it. No, it's absolutely imperative. And I can't echo, your sentiments about having like professionals that are working together on your behalf. I think that's why we make such a powerful combination. And I think everything's working great. So really happy to have you here. We're going to jump into our content here, which is a little bit different. I hope nobody's disappointed, but we're not going to have a PowerPoint today. We're going to do just more of like a live Q&A here with me and Adam. And so, like I said, for everyone joining in, if you do have any questions, type those in the Q&A as we go. Somebody said go Gators too. Doug did, Adam, to razz you a little bit
Oh,
there. Yeah,
it's okay.
but
It's a great school. It's a great school.
there you go. So, but we're going to mix it up a little bit. So no PowerPoint presentation. We're going to do more of a Q&A kind of interview session back and forth between Adam. He's going to ask me some questions and then I'm going to ask him some. But if you have any that come up along the way, pop them in that Q&A box. We're happy to answer those too. So with all that being said, I'll let you start firing away there, Adam.
Yeah, I guess so. Just the big picture, right? So we work with a bunch of business owners, and Some make X and some make Y. And so I guess why do they, and then some even business owners that make a tremendous amount pay a lot less in percentage of taxes than maybe some that are making a smaller revenue or overall profit. Maybe start with a big picture of like, why is that the case?
So no, it's a great question. It's one we get all the time. We've even have it come up where there'll be like 50-50 owners of a business who are compensating themselves the same from like a salary perspective. They're 50-50, so they split the profits, but at the end of the year they both pay different amounts in taxes, and they're always asking us why. It's because it really comes down to your personal situation. Everything depends on your personal situation when it comes to taxes, and it all sort of funnels down in that way. And so just to kind of give you like some different examples of how that works, if in that scenario, if you had two partners who were paid the same salary, had the same split of profits throughout the year, one might be married, one might file their taxes single, one might have dependents, one might not have dependents, one might own interests in three other businesses that one of them is specifically designed to have a lot of depreciation expenses to offset all their active income from the business. Like there's kind of an unlimited amount of dynamics, but it really boils down to your personal situation, in my opinion.
So let's talk more about kind of the main title of this, which is planning beyond April 15th. And I think you've said before, like tax preparation reports history, right? But tax planning could change the future. So when you talk about like what does planning beyond April actually mean from a tax perspective?
Yeah, I mean, planning beyond April. So to me, April is like we're just getting started, right? For most people, they're used to just now starting to talk to their CPA or to just now starting to talk to their accountant or tax specialist or tax strategist for last year, where we're the total opposite. We want to have all of that stuff already situated, already taken care of for last year. So by the time it gets to preparation and filing time, we already know what to expect. So for us, this is really like the starting line for 2026 of, okay, what sort of income are our clients expecting to make this year? What sort of new strategies are out there that we can bring to their attention? What, sort of proactive things can be done to maybe restructure their entities or all sorts of different things throughout the course of the year to make sure they're proactively legally and morally paying the least amount of taxes as possible. So I think it's just the biggest difference of like instead of this being the finish line for last year, for us this is the starting line for this year.
Legally and morally, I love that. So, okay, well, let's talk more about. I know we talked to a lot of people. What are some mistakes and kind of missed opportunities that whether business owners or W-2 income earners see? Like, so what's like let's maybe focus on business owner. What's the biggest tax mistake you see over and over again?
Really just not being proactive and not learning from your mistakes. I don't want to say every successful business owner, but most of them, within the one of those first couple of years of like explosive growth, have gotten caught off guard by a surprise, really high tax bill. Once that happens, there's ways to avoid that in the future, and there's ways to proactively navigate that and work around it. You don't want to keep repeating the same thing over and over. Is one, and then number two is just as boring as this sounds. I know you give me a hard time about this all the time, but it's like not having good bookkeeping, not having good records in place. When you don't proactively manage that stuff, it makes it very hard for somebody like me or somebody like you to give you advice that actually fits. And so if you don't have a good like bookkeeping and accounting system to know you don't need to know exactly where you are, but pretty close to where you are throughout the course of the year. That's one of the biggest mistakes that I see.
So let's talk about things that you can write off, right? So whether you're a business owner and you're running a manufacturing company or if you own investment real estate, right? Because I'm sure some of the people on the call have maybe not business owner, but maybe they own investment real estate. And I saw on Instagram or Facebook this tax person that said, "Hey, I just bought a Rolex. You can write that off from your business." Well, obviously, at least I don't think that's true. But what can business owners actually write off, and what can they not?
So, it's a great question. The easiest way to explain that is any expenses you incurred in the pursuit of a profit that can be considered justifiable by the Internal Revenue Service can be written off. with that being said, they're not that exciting of people, and they're not very easy to convince about items that would seem unreasonable. So something like a Rolex, if you take that into account, a lot of people, for whatever reason, maybe they saw it on Instagram or social media that said, "Hey, I need a Rolex to impress my high-end clients and fit into their social circle, so this should be a marketing expense." It's not the case. The IRS is not going to agree with you on that one. However, if you own a watch repair store, or you're a watch manufacturer, or you generate income from selling or having something to do with watches, then maybe it could be justifiable. That's one, that comes to mind. Entertainment's another one. They got rid of that years ago when they passed the Tax Cuts and Jobs Act. So it used to be where you could buy, tickets to a football game or a suite and that sort of stuff and write it off. Can't do that anymore. No more golf. And those are just a couple that come to mind right there. So,
I guess what are any tax strategies that maybe business owners haven't heard of? Obviously, with some of the recent changes, like they brought back the Section 179 plan. What does that mean for people? What are some strategies that maybe some of the people on the call have not heard of before?
yeah. So Section 179 is a big one. It's also known as bonus depreciation. With the big, beautiful bill, one big, beautiful bill act that passed last year, they brought that back to 100%. That was actually on pace to only be at 40% this year, then 20% next year, and then sunset and go away next year. So that moving from 40% to 100% is huge. It basically means if you're buying assets for your business, specifically around vehicles, if you use it for more than 50% business use and it weighs over 6,000 pounds, you could potentially deduct up to 100% of the total cost of it in 1 year, which is really huge. Where it's cool now to be in filing season where we're like seeing the effects of how that can help people out. We were just working on a return yesterday. I was finalizing, and it was able to give a client, I think it was like a $52,000 deduction for their new Cadillac Escalade that they purchased for their business. And so, that's one of them that's out there. Another one are we've been doing more and more of these like leverage donations and leverage investments. It's been really interesting to work with you on those, Adam, where a lot of people don't realize there's investment programs out there, there's donation programs out there that are set up in a way where you can invest in these programs. They're specifically designed to give you tax advantages in the first year or two of signing up for them. And then there's actually chances of a return on your investment in the future. There's other ones that pertain to the same way with donations, where there's companies who are set up with IRS in such a certain fashion where you can donate money to their organization at the cost of them making those products, but you actually get credit back at the fair market value of what they sell them to the public for, creating instant leverage as from like a charitable donation standpoint too.
So just to kind of piggyback on that, so let's say if I itemize, because it sounds like charitable donation category, right? If I itemize and I donate $100,000 or $50,000 to this leverage donation program, what can I expect to reduce my taxable income by?
Yep. So like use like a $50,000 example. This is one of the programs we had available last year. There was a 5 times multiple on your original charitable donation amount. So if you were to donate $50,000 to this organization, you actually get credit for a $250,000 donation on your tax return. If you're in the highest tax brackets, which like 35, 37%, that automatically equates to an $82,000 tax savings, essentially turning your $50,000 donation into an instant upside of $32,000.
And then is that just in year one? Does that go to year two? Do I get anything returned, or is it purely a donation that like, hey, thanks so much, and it's merely just the kind of the delta, the arbitrage of the 30 plus thousand net difference to me?
Yep, with the donations, those are more set up as an instant tax mitigation strategy. So the main reason we're doing it is to donate to charity, and these are amazing causes and all of the amazing things that these companies are doing out in the world. But in reality, this essentially turns your $50,000 into $82,000 instantly. So in the donation standpoint, there should be no expectation of like a return of your investment or any of these sort of things. You're essentially making a donation to these organizations.
All right, so I got another one. We got the Masters coming up, right? So played in beautiful Augusta. What's this
Ah,
Augusta rule I hear about all the time?
Yep. So very popular. And the rumor is you can't find anywhere, the IRS doesn't actually acknowledge this or admit to it or whatnot, but the rumor is the Augusta National Golf Course, the Masters Golf Tournament every year, that city is not set up to handle the hundreds of thousands of people that come swarm on it for the 2 weeks out of the year that they have this golf tournament. So the houses on the golf course can rent for insane amounts of money for the players and their families and all of that sort of stuff. So the rumor is 40 or 50 years ago, the owners of these houses in Augusta, Georgia, actually went to Congress and lobbied to say, hey, when we rent these houses out, we don't think we should have to pay taxes on this money. And so they passed the Augusta rule or Internal Revenue Code Section 280A that says if you own your home, you can rent it out for up to 14 days per year, and the income derived from that activity is tax free to you as a homeowner. So it could work in situations like that. If you live in an area where all of a sudden your house can rent for 40 or $50,000 a week, you could rent it for the 2 weeks up to 14 days and not have to pay taxes on that money. For some people that makes sense. If I guess if you were here in the Tampa Bay area and you had a amazing condo downtown and the Super Bowl was coming to town or something like that, it might apply. But where it can apply to business owners, where it gets real interesting is if you own a business, your business can rent your home from you. You have to charge in line with going market rates. You have to host some sort of business activity there, but your business can actually pay you rent for that. That's now a deduction from your business income. It's tax-free income to you as a homeowner.
Interesting. And is there like a certain dollar amount that you should be capped at, or like where do you find, hey, I'm gonna rent my house out to my business for entertainment or for a meeting? Like, how do I find out? Is it square footage? Is it like my neighborhood? Like, how do I find out what's the appropriate dollar amount I can charge for those 2 weeks?
Yep. No, great question. So there's not a specific schedule out there, right? The IRS isn't real big on details. They sort of love playing in the gray area. But it has to be in line with going market rates for a similar type property to host a similar type event. So the best website we found out there is a website called peerspace.com where you can look for conference rooms for rent, that sort of stuff, studios for taking pictures, and all sorts of other things too. You can also use, things like Zillow, VRBO, and those sort of things too. The IRS doesn't put a limit on it, but I will say you need to be charging in line with the going market rate. So it doesn't mean like, hey, I could have my solo directors meeting in my house once a year and charge 100,000 for it. It doesn't mean that, or absorbent kind of crazy amounts, on a monthly basis. It's got to be similar to what you would pay to rent a hotel conference room or space, or if you got a fancy backyard like Adam does, you could maybe charge a pretty penny for that. Because in reality, if somebody wanted to book that space and come throw a party or throw a work event or whatever, you would essentially charge similar to what they would. So,
Good to know. I'm gonna just charge a significant amount for my backyard and write it off from the company. It's great. So all joking aside, the other question too. So let's say we have a lot of clients that are still W-2. They're not business owners, but they're making great money, right? They're making 300, 400, 500, a million plus a year in a W-2 capacity, and maybe their spouse has W-2 income too. So they're very limited to maybe the deductions that are out there for business owners and everything else. So let's say hypothetically a husband and a wife are in the 37 plus percent tax bracket. So their W-2 is above 700,000 or even 500,000 collectively. Are there any strategies that they can do to help write off, any income? I know we talked about, well, maybe if one has a business idea, they could potentially open up a business. Like, I guess the question is, if we're just high W-2 income earners, what are some advanced strategies or strategies maybe clients haven't heard of before that they could use?
yeah, yeah. High W-2 earners in our world, this is like a blessing and a curse, right? It's amazing, and I really mean this. It's amazing to be an employee and work somewhere and be able to make large levels of income, right? To be an employee and make 400 or $500,000 a year working there, in my opinion, is truly amazing. But from a tax perspective, they're kind of hit the hardest out of everyone. And so the number one thing is you want to max out all of the employer offered benefits that they have there. A lot of people don't know. We'll see people making 400 or $500,000 a year, and they haven't even maxed out their 401k. They're just doing like the 1 or 2% out of every paycheck. One of them is they can put up to $23,500 each into those company 401k plans. They have things like HSA, FSA, children tuition assistance, basically any tax advantage programs the employer is offering, you want to max those out. And then from there, we want to look to be creative as possible. Those would be perfect candidates for the leverage donations I was just telling you about, especially if they're in that like 700 plus range that you were just describing. The leveraged investments could make a lot of sense too. The cool thing about those is there is a potential of a return on your investment, but you're still going to get those tax advantages up front. And then one of the big things we look for, or we work with clients through the process is there anything anyone does on the side? A lot of times these high performing W-2 employees, I'm not sure what it is, if it's the personality or why this is, but they usually got like 1 or 2 little side gigs going on that they don't understand. That can open them up to be taking all sorts of business deductions and incorporating a lot of the things they're already spending money on, but we could turn those into business deductions. So those are just a couple of things come to mind.
And then, so let's say my spouse or myself, we open up, I'm a W-2 earner, right? We open up a business and it's consulting or it's watch repair or whatever it may be, right? So what can I
You're
show a
trying to get that
loss?
Rolex right off, huh,
I'm
Adam?
trying to write off this Rolex. Like, how do I open up a business to write off, dumb purchases? So how do what if I show a loss? What if I say, listen, I'm trying, there's not much revenue or no revenue. Can I still take like home office deduction? Can I still take vehicle or marketing, things that I'm trying to legitimately use and spend money for to help kind of generate revenue, potential revenue? How long can I show a loss in that company?
Yeah, 100%. So the IRS has what's called a 3 out of 5 year rule. So for a business not to be reconsidered as a hobby, which if that happens, the IRS is going to disallow your losses, it has to show a profit for 3 out of 5 years, which essentially means a business can show a loss for 2 out of 5 years without any sort of red flags or any sort of means for the IRS to take those deductions away. What I will say is it has to all make sense, right? It has to be justifiable. But in reality, that's the rule is companies can show a loss for 2 out of 5 years without any scrutiny from the IRS. Also, in reality, there's companies like Amazon that showed a loss for 25 years before they actually became profitable. So we would never advise going that long. But in reality, if this is money that's actually spent in the pursuit of a business opportunity, more than likely it's going to be justifiable as a business expense.
Cool. You mentioned kids earlier. So I have an 11-year-old daughter and two 8-year-old boys. If I'm a business owner, can I add them to the payroll?
You absolutely can if they actually perform a role in the business and you pay them in line with going market rates for somebody else you would hire to do similar activities.
So give me an example. What can my 11-year-old do?
So this is great. I'll tell you first. I'll tell you what I don't want to say what the 11-year-old couldn't do, but probably the route we shouldn't take, which is where a lot of people get these ideas and they think that whether it's the social media video or whatnot. But what you probably wouldn't want to do is take one picture of your 11-year-old on the beach, put that on your company website, and then say you paid them $15,000 as a modeling fee for the year. That's not going to be something that's justifiable, or that's not going to be something the IRS isn't going to be very excited about that one. What you could do is your 11-year-old, no offense, but she's probably better at technology than the both of us, right? What you could do is hire her as like an office admin assistant or some sort of executive assistant to help send follow-up emails to clients or come in the office and write thank you notes and mail them out to your clients. They could even clean the office. They could do all sorts of different administrative activities. You would just need to document everything properly, pay them in line with going market rates, and then it's 100% justifiable at that point. And even down to the 8-year-olds, and maybe even like 6 or 5, right? I think the thing here is just don't get carried away. If you're going to say your 2-year-old earned $15,000 for a couple of pictures or videos, that one's going to be hard to justify during an audit. So
So if I add the kids to the payroll and they have earned income, what are any strategies we could do there?
100%. Well, first of all, a lot of people don't realize you can pay them a little over $15,000 per child per year. So now that money is a deduction from your business, right? And it's tax free to them. Once they have earned income, they work with somebody like yourselves. They could set up like a Roth IRA for the children. So now we have this retirement account where we're putting money in and it's growing long term for them over time. So that's just one of the things we could do. We could also utilize like a 529 plan. I mean, there's several of other items too. Essentially, once you have the money out of the company, right, try not to use the terms whatever you want, but you can kind of do whatever you want with it. We would definitely recommend putting it away to some good long-term use though.
So kind of going on that business owner standpoint. So an LLC, subchapter S, partnership, sole proprietorship, C corp, what do you when people are set up a company, what do you recommend like the structure of that entity be and when does it make sense to go to an S corp? When does it make sense to go to a C corp or something? I don't know if you can speak on that or if there's any rule of thumbs.
Oh yeah. Just so there's really not a rule of thumb. That's kind of the thing in our industry of we're not trying to be vague, I promise, but our my favorite answer is it depends because it depends. And it a lot of times it depends on your personal situation and what you have going on and then like what the long-term strategy is overall. So kind of give you an example. A lot of people when they first set up a business, they'll do like a single member LLC, which is great because it allows you to have like a separate EIN number, separate bank account, but it doesn't really do anything from a tax perspective. If you're earning money, self-employed, and all of that is taxed as a single member LLC, it just gets attached on your personal tax return and you automatically pay like 15.3% self-employment tax on all of that income. So it kind of eats you alive from a tax perspective. A lot of people we see they for whatever reason they think when they're starting a business they want their spouse as like a 5% partner or they want to be 50-50 partners. That's fine. A lot of people don't realize, but now when you go to register for the IRS as a partnership, because there's more than just the single member, you're required to file a partnership tax return every year with the IRS. A lot of people get caught off guard on there. It's not a big deal to file it, but it's separate from your personal tax return. And if you don't file those partnership returns on time, the penalties for filing those late can be ridiculous, you know?
Hmm.
So that yeah, then you go from there. If you are a single member LLC, your net income, which is all your revenue coming in after expenses, whatever that bottom number, once that gets over around 50,000, give or take, then maybe we want to look to be taxed as an S corp because the savings on that self-employment tax portion are going to be exponential at that point. So just a couple that come to mind right there.
Yeah, self-employment tax is what, 15 plus percent from the employer side?
For both is 15.3%. So, and that's on top of your federal income tax. So, if you make a ton of money as a sole proprietor, single member LLC, you're paying, say you make 100,000 bucks, you're paying federal income tax at whatever tax bracket you end up falling in. Then you're also paying an extra 15.3%, which in that case would be an extra 15 grand in self-employment taxes.
So if I'm an S corp and I pay myself a W-2 and I pay myself 180,000 a year, can I potentially change that and reduce it down to 80,000 a year to save on some of the self-employment?
Absolutely. So the benefit of the S corp is the arbitrage on the amount between the Social Security cap. So if you are an S corp and you're paying yourself $180,000 in wages, you're kind of I'll say you're missing the point. That could, sound a little abrupt, but you're missing out on the benefit because what's the Social Security limits? Right around 162,000, something like that. So
Yeah.
every amount below 160 is how we calculate how much you're actually saving. So depending on the net income of your business and depending on what you're actually doing in the business, our goal would be to have your salary as low as possible so you can pay the least amount of the IRS is crafty, right? It's the same amount, it's 15.3%, but now they call it payroll tax instead of self-employment tax. So we want that salary to be as low as possible. We also want to look to do things like incorporate your retirement plan contributions into your W-2 salary. So now we're keeping the IRS happy from a payroll tax standpoint, but all that money is actually filtering through to you in a retirement plan that's going to help you build the long-term wealth.
So even if I still need the 180 to live, I can reduce that down to 80 and then take distributions to kind of fill the gap of what I maybe need from lifestyle.
Yep, you can absolutely do that. And so, depending on kind of like I said, what your role is in the business, and sort of like calculations of other people in the similar industry. We'd want to look to find what the IRS calls a reasonable salary. But in our opinion, we tend to be a little aggressive. We want that number to be as low as possible. So,
Got it. I guess, is there anything else that business owners should be thinking about, or so should we be filing kind of these estimated returns or kind of contributions from a tax standpoint, or should I be setting aside a certain percentage of my income every month or every quarter just so I don't get caught off guard?
I would be setting something aside if you're working with somebody and planning on a regular basis. You should kind of know what to expect throughout the year, right? So what a lot of our clients will do, and everyone's different, right? I kind of use the example of there's a spectrum. There's people who are on one end of the spectrum who say, I'm terrified of the IRS. I want to pay them way ahead of time throughout the course of the year because I don't want them to come mess with me. I'd rather pay them a little bit extra so they just stay away. And there's people on the other end of that spectrum who say, like, the IRS wants a penny from me. They're gonna have to pry it from my dead, dying fingers. I want to give it to them as late as humanly possible. So, like, wherever you are on that spectrum, we can accommodate. We're not real big on making quarterly estimated payments unless your income is significant, multiple six figures per year from your business. What we'll typically have them do is keep that money in some sort of investment account that you can manage for them so they can earn 8, 10% on that money throughout the year. As long as we know what to expect, they make those final payments by April 15th. The penalties and interest are very minimal for not making estimated payments throughout the course of the year.
Okay, that's helpful. One last question too, because I go all day with these. Because I'm a dork. I got one of these little cool letters. So let's say they work with you and they work with Action Account and they go, "Hey man, you just saved me X amount of dollars. That's phenomenal." Can I look at previous years where I wasn't taking advantage of some of these strategies or things that I missed? Is there anything you guys can do? Can you look back?
Oh yeah. So I mean that's part of our pretty standard process when we bring on new clients. We'll always look for amendment opportunities in the future. In reality, if the client, sometimes the clients will know. They'll be like, "Hey, I bought a vehicle, but for whatever reason, my CPA said we couldn't do that depreciation thing," or I brought this idea to their attention and they just instantly shot it down. If there's something like that, we want to 100% look and see if we can qualify for it. But other times there's just a difference of opinion of how things are categorized. A lot of times it has to do with depreciation or amortization. So the short answer is yes, we absolutely will look back and look for reasons to amend and try to get the clients back more of their hard-earned dollars if possible. But also in reality, the true magic is really in moving forward. Some of these things, a lot of these strategies have to be put in place before the end of the calendar year to be able to qualify. So the real magic is in moving forward, but we'll always look for opportunities in past year's returns, absolutely as well.
Good. All right, I'll stop there and keep going. But yeah, I don't know. Is there anything else that maybe you want to share that I missed or I didn't bring up?
No, I think you're doing great. But let's switch gears a little bit. Let me ask you some questions here. And then
Sure.
two, to our people out there, if you got any questions, pop them in that Q&A box. We can answer those. And we'll answer them as we go, or we can have plenty of time there to answer them at the end. I'll tell you from a financial planning perspective, Adam, what to you, what's the difference? What's the biggest difference between someone who earns high income, so somebody who makes good money, and then somebody who actually like builds long-term wealth?
Yeah, so someone who earns high income may not be wealthy, right? So I believe that when we say this to clients all the time, that income creates opportunity, but the behavior you do actually creates the wealth. So, and even like with, unfortunately, today's society, I think it's even worse than it was before. A lot of our coaching for our especially younger clients is that, hey, if you get that raise, if you get that new promotion, if you get whatever, and your income goes up, what we typically see is that high income earners often inflate like their lifestyle, right, as their income rises. So there's even a study out there that those that are making 200,000 a year are still living paycheck to paycheck. Now, granted, it's a lot more expensive to live now than it was 5, 10, 15 years ago, but what we found, it's almost this immediate gratification society to where if they make another $10,000, they're spending another $10,000, if not more. So we talk about whenever someone gets a raise or a promotion, we treat it as half of exercise money and half of ice cream money. And what that means is that, hey, if you get a $10,000 bonus, Cool. Go do something fun with $5,000 of it. The other five should be assigned a job, being put to work. And so when we talk about, hey, let's just go back to the basics of financial literacy 101, we talk about the 20-60-20 rule, which is ideally we want clients to save 20% of their income first and foremost. 60% should be for their fixed costs, kind of their needs, if you will. And the other 20% of the 20-60-20 rule should be for more discretionary wants. But if we look at if the first 20%, if we can avoid the lifestyle creep with additional income, exercise and ice cream exercise, and if we can consistently invest 20% first and foremost, because it's so much easier to save first than it is to spend first and then try to save, investing that 20% consistently really builds a strong muscle to help them long term. So we love that, right? So it's more of even if you're making good income and you increase it, try not to buy that fancy Escalade or that Rolex that we talked about, and let's figure out how can we create behavior that can really build some long-term wealth.
I love that. What did you call it? Exercise money and ice cream money?
Yeah, half exercise, half ice cream money. So
It's kind of funny you mentioned that. I'm thinking back to my personal situation at the end of last year. It was, got a nice little bonus from the company, and I was talking about some things, and I was almost a little shy to tell you at first, like, man, I want to buy this new golf. I'm going to do all this other smart stuff, but I want to buy this new golf cart for my neighborhood too that my kids will love. And you were all about it, and that actually that makes a big difference. It's like you want to feel like you're enjoying the ride along the way too, right?
yeah, no, and again, we do believe we're not the financial planners that say you save everything, you need to eat ramen noodles, you need to do all that, right? That's not what we're saying whatsoever. What we're saying is like let's set up a plan and let's try to save first and then spend later. And depending on your income, if your income's below, let's call it 100 grand, well, that might be a little bit more difficult to save 20% of your income. So let's set that target for 15. If your income's above 250,000, well, maybe let's set that target for 25. If it's above 500,000, you should be saving 30+% of your income and kind of avoid buying the additional Ferrari or whatever you're doing. So ideally, my goal is that I'm good with money, but if it's immediate and right in front of me, sometimes I go, hey, shiny new object, I want that. But if I set it up to where everything's automated, where investments come out here, I have deferred compensation, I've got my retirement plan, I've got cash value life, I have all these different strategies and plans that if I pull from my income first and foremost, I really can do whatever I want with the rest of it, right? So it's that exercise first that allows me to have that ice cream moments, which is still part of spending your life and having fun with it.
And having a golf cart to drive around your neighborhood with your two little kids.
I've seen your golf cart; it's pretty sweet.
It's pretty cool.
Yeah.
So what's something people think they're doing right, but it's actually hurting them long term?
Um, Probably trying to keep up with the Joneses, as I mentioned, for sure. Thinking that, hey, this is good, or I'm going to buy this, which is going to get me in a different circle or elevate kind of me. And they're not really they're not setting aside money. And they're also not talking to, I mean, this is a plug for me and kind of financial advisors and planners, but they're not talking to advisors to look at, how do we focus on tax efficiency? How do we think decades in the future, not years? And then visually kind of showing a lot of clients the power of compound interest. And if you just save this, if you just do this, and if you look at more of the decades in the future, that's a huge thing. So, and a lot of people that they're not, I think, so this year so far has been very, very challenging from a geopolitical and then just market in general. And so these are great opportunities to look at things like Roth conversions, which we're doing a tremendous amount of, and then finding certain areas that we should be buying that we think are on sale. So what they're not doing, short answer is they're not getting professional guidance and having someone that's a coach for them or an advocate to make sure that they're doing the right things.
I couldn't agree with you more on the having somebody to work with. I think this day and age, it's almost it's a good thing and a bad thing, right? Of with social media, there's so much access to information out there for free, but how do you know at the end of the day, how do you know at the end of the day if that actually applies to you or that's gonna, make sense in your situation?
Agreed.
So, is there like a general percentage people should aim to invest? I think you talked about this a little bit. What was that, like 60, 20, 20, you said?
Yeah, 20, 60, 20. And then so some people will say, like, well, hey, do I put that all into cash? Do I put that all into my retirement plans? Do I put that all into a non-qualified investment account? The short answer is no, right? So a lot of it, we talk about tax diversification and then asset location. But the tax diversification is, again, kind of that post-tax, pre-tax, that traditional Roth style. A lot of our clients, we want to make sure if they have liquidity needs, that they're saving in a non-retirement account, because that may be a little bit more useful if they go to buy a large piece of real estate, or if they want to buy a home, whatever the case may be. Sometimes we need that liquidity because some retirement accounts you're not really supposed to touch until 59 and a half or older before you typically have an IRS penalty fee, as you know. So more of it's like, hey, the non-qualified account, where do you set money aside? How do we do things like tax loss harvesting in that? But ideally, we want clients to set aside average 20% of their income, depending on kind of what their household income is. And then we want to make sure they do have a safe bucket of cash. If both husband and wife or spouses are working, they should have about 3 months of expenses set aside. If there's only one income, we should have about 6 months of expenses set aside in either cash or cash equivalent, which we can talk about more if you like. So yeah, so a lot of it is, yes, saving 20, but making sure it's in the right location.
I like that. I like that. You kind of answered part of this, I think, but maybe you could expound a little bit. So, like, where should somebody prioritize? Is it like paying off all their debts? Should they immediately go to investing? Should they build cash then do these? Like, what's your take on that?
So I'll give you a favorite answer. It depends, right? So it depends on
Hey, there we
really
go.
if they have debt and they've got credit card debt at 20+%. Well, obviously that's going to be a priority because yes, our portfolios have done very, very well over the last X amount of years. It involves risk. There's still volatility there. So we may advise them to get rid of some of the highest percentage of debt that's out there. We may advise them to set more money aside in a liquid bucket if there's a large financial purchase coming up. So I guess it really depends, and I would advise everybody to find someone they know, they like, and they trust to bounce ideas off of.
That's fantastic. So like what's one simple thing, if somebody's new to this or if they've been working with somebody for decades, like what's one simple thing they could do to improve their financial future like in the next 30 days?
I would ask their advisor if they are working with someone, like, hey, what are some new things out there that maybe the Secure Act 2.0 brought to the table, or the One Big Beautiful Bill brought to the table? I'll tell you one thing that's been extremely popular for a lot of clients, as it's an above the line deduction, which is oil and gas contribution. So I think we've talked about this recently, but oil and gas contributions, one, if you invest in things like natural gas, so there's a fund out there and it's already closed for last year, but it's going to open up pretty soon in 2026. And they do horizontal fracking outside of Western Pennsylvania for natural gas. Well, I'm a big optimistic and bullish behavior on natural gas, as well as nuclear or uranium, just overall energy sector, because with all the AI boom the last, call it 2, 3 years, there's going to be a huge need for demand of energy. And I think natural gas is that easy stepping stone. So these oil and gas contributions are two things. One, they can help with reducing taxes now tremendously, and then they can help with future income in the future. This one company we're talking about on the natural gas, there's a 70% deduction in year one of your contribution because it takes advantage of what is called intangible drilling costs, which are the non-salvageable costs to be able to set up this well or whatever it may be, labor and just operations. And that's all deductible. So in this case, 100% of that IDC, which is 70% of that contribution, deductible in year one, 16% in year two. And then these funds are shooting off 1 to 2% a month from overall distributions as a limited partner. And it's extremely popular right now. One, because the energy demand sector itself in the market. And then two, the deduction of taxes. And then three, the passive income that can help long term. So that's just one little strategy. But the big thing is they need to ask their advisor or team, what are some new strategies that have come to the table that weren't here 5 years ago?
I love that. I love that. Let's talk a little bit about Roth. That's something that we get a lot of questions on, and not that we're against it by any means, but like from our world, I'm thinking tax. Like, how do we get the tax as low as possible this year? A Roth doesn't really, help in that scenario, but how does that factor into people's like long-term wealth strategy?
Yeah, there's a couple good books out there, short read called Die with Zero and Tax-Free Retirement. And ultimately, the premise there is that if we can avoid a large variable, which is taxes now, and not have to worry about what Uncle Sam does in the future, that's a pretty big deal. One, historically, as you know, taxes are really, really low from looking past 30, 50, 100 years. But also, if we can do things like a Roth IRA, Roth 401k, or some after-tax contributions, you could increase liquidity because you're able to get to Roth assets much easier and sooner than you could with traditional. But also, as that seed grows to that large harvest, well, when you go to take money out, it's all going to be tax-free, which could help reduce things like Social Security or distribution, could help with Medicare Part B and Part D because there's a income called IRMA, which is income related monthly adjustment for some of your Medicare supplements. So there's so many other benefits to Roth assets, whether it's an IRA, a 401k, and even from a generational standpoint, as we talked about, even kids having Roth IRAs, just what those look like long term is incredible.
I love that. And we're coming up to the top of the hour here. Time flies when you're having fun, right, Adam?
Yeah.
Um, so if anybody has any questions, type them in there. We'll make sure we answer them. If not, I've got enough here. We could probably talk for another hour if we had to easily. So if you do have any questions, type them in there. We'll make sure we answer them. In the meantime, I got a couple more for you, Adam, here. So like, what's your take on, real estate versus the stock market versus, hey, I own my own business and that is my retirement plan?
So I'm all about diversification. I have investment real estate in Cashers. I bought my mom a piece of property where she pays me rent. So I love that because it helps with leverage, it helps with deductions, it helps with passive income. But there's more active management there, right? So you got to really kind of help with the property management, if you will, or to hire someone. As far as
Managing
the
the
stock
tenants and
market,
all that. Yeah.
right. And then worry about variables of like insurance or if you have a mortgage, like what that looks like. And then, so there's a lot of things that are there. But again, I think it's a great part of a diversified portfolio. As far as the market, I mean, that's obviously, I may be a little biased because it's what we do every single day, but having the liquidity of money in the market, having the potential growth. If you look at the S&P 500 over the last 6 years, it's gone up almost 180%, which is crazy, even with 2022 being down almost 18%. And even with the crazy just volatility we've had in the market due to tariffs, Iran, or whatever Trump is tweeting or posting, whatever Truth Social it is, there's still a lot of incredible gains. If you look at the S&P 500 in the last 12 months, it's up 30%. 30%, even with the first quarter of this year being pretty challenging. So I love the growth potential of stocks. I love the liquidity, and I love just the research behind it. I feel like you're well tuned into what's going on in the economy when you own equities, you own stocks like an investment portfolio.
Absolutely. That makes a ton of sense. And then how often do you see, business owners where their entire retirement plan is like, hey, selling their business and riding off into the sunset? I can tell you, unfortunately, like from our perspective, a lot of times the business doesn't sell for anywhere close to what they think it will, or if it does, it takes much longer. And then all of a sudden they've got, some incident come up where they expect to be out in 6 months, but they've got to be around for another 2 years. Is that something you run into as well?
Yeah, business owners, they have so much belief in their company as they should, right? But yeah, they typically, what we have found is most business owners invest everything back in the business, assuming
Time,
it'll
money,
eventually,
energy. Yeah,
right, assuming it'll eventually fund retirement, which is good. That's your home run bucket. But again, well diversified portfolio. Even if you think about the executives in Enron days, they were so heavily concentrated in the company stock. Well, obviously, we saw what happened there. And so when business owners are really just all into one bucket, and maybe they're forced to sell during a downtime or recession, and they have this pretty large discounted valuation of their business that they thought was much higher. So if you have everything in that one bucket of your home run bucket, which it probably is, well, that could be challenging because it may be horrible timing when you're saying, "Hey, I'm done. I want to sell it," and then there's taxation to it, and then again, it's just timing. So what we found is that yes, if you plan for an exit 5 to 10 years out, there's easy ways to take things off the table that still help with the overall valuation. But investing outside the business or rainy day is definitely crucial to one's plan.
That makes a lot of sense right there. We'll start kind of wrapping things up here. We got just a couple minutes for everyone who joined us. We really appreciate it. If you do have any questions, type them in there. We'll make sure to answer them. If not, I'll ask you, Adam, so like from your perspective, how important is it for somebody to work with a team, where like their financial planner, their tax advisor, maybe their estate attorney, how important it is for those professionals to work together on the client's behalf?
Yeah, it's a softball pitch there. So obviously having the having the one team and obviously how we've kind of built the business, having you in house, having the estate attorney in house, having the experts on the insurance side, the financial planning side, that's great. If you get all these experts that are in their lane talking and moving in the right direction, I think that speeds up conversation. I think there's a tremendous amount of efficiency between the experts. And I think it helps, as cliche as it sounds, the client to sleep better at night, knowing that they have a team and it's kind of that one-stop shop all under one roof. And it's definitely helpful.
I couldn't agree with you more there. And so for someone out there watching, they feel that, they're not totally confident in their team or their financial plan. Like what would your advice be to them?
Taylorfinancial.com, book an appointment and go from there. No, I mean, just I would interview 2 to 3 advisors and teams, feel who you connect with, ask them about are they a fiduciary, ask them about their fee schedule, ask them like what their long-term strategy is, what's their succession plan, what's their potential exit, what's their belief in the market, what's their like, there's so many questions that someone can ask to feel comfortable about their tax estate insurance investment advisors. So yeah, I would interview a bunch and then just make sure you constantly talk to that person because life changes and things, not only laws and bills and everything else, but individual income and life changes that those advisors should be aware of.
I couldn't agree with you more there too. So if you're out there, if you're listening, taylorfinancial.com, you can always book an appointment right on Adam's calendar. If you need help with your tax strategy or overall accounting and tax prep needs, go to actionaccountingusa.com. You can book an appointment with me right there too. We're right about at the top of the hour. So if anybody has any questions, type them in there. We'll answer those. If not, Adam and I will get back to doing what we do best. So thanks so much, Adam. Really appreciate the time. Always a pleasure for everyone who listened to it, or if you're listening to this recorded afterwards. Thank you so much for taking the time. I'm Jake Alexander from Action Accounting. We'll talk to you soon.
See ya.
See ya.